Mr. Chukwu, welcome to the program and thank you for joining us.
Thank you, Nancy, for having me. Good morning.
Good morning. Let's take a look at the morning after MPC meeting. Did the MPC meet your expectation yesterday? Were you for a cut, a hold, or what's the next one? A rise?
Well, I was for a hold, and in my previous projections or predictions, I had actually predicted that the Monetary Policy Committee will hold all the rates, all the parameters. And simple reason is that given the economic situation or conditions of the country, it would have been very difficult for them to either tighten or loosen. Tightening will also mean that they are contradicting everything that is going on, not just in the country, but globally. Virtually all the central banks in the world are trying to stimulate economic recovery. So you can't tighten at a time when the primary objective is to stimulate economic activities. At the same time, you really can't afford to loosen when you are seeing so much pressure on your FX reserve, FX exchange rate, and inflation rate. You just mentioned that we've seen an uptick in inflation rate to the point to 12.56% in June. So with such increase in inflation rate and the huge pressure we're seeing in the FX market, they couldn't have afforded to loosen. So, and we are left with using unconventional monetary policy tools to drive economic recovery.
So, the morning after MPC, what is the best opportunity to take after this MPC right now? As someone that watched it yesterday, and of course you follow this, the MPC is always done, I must tell my viewers, 6 times a year. The next MPC should be in September. The last one should be in November. So the MPC meeting held 6 times a year. So what's the best opportunity for you right now, the morning after?
Okay, what I would say is that, Nancy, the opportunities available in the economy will largely be driven by where the demand will go to. And demand will go to basic items in terms of the general economic activities. If you look at financial assets, financial instruments, of course, we know that there's been a lot of reasonable interest in the equities market because return on fixed income instruments has actually gone very low. As you know, the central bank has actually excluded private sector investors and instruments, in OMO instruments. So that left the private sector investors, such as fund managers, that is PFAs, to invest only in treasury bills. And you see the treasury bills yields are in the region of 3% for 364-day bills. And recall that the inflation is at 12.56%. So there's a disconnect between inflation rate and the yield on treasury bills rate, which is risk-free instrument. So that actually leaves investors looking for any investment instrument that can give them yield above 3%. And the first choice that you've seen investors make is to go to equity instruments that have strong dividend yield. There are some instruments that give you dividend yield of 5-7%. And they also look at price to earnings ratio. If you look at some of these stocks, some of them have only PE multiples of two times. Some at 3 times. So in effect, they're saying that if you invest in such instruments or such equity instruments, even if they don't pay you dividend, the value of your investment will triple or double after 2 years or 3 years, based on the earnings of such companies. So you are seeing a lot of interest going back to strong equity strong companies' equities. And then the other aspect that is driving investors is in dollar-denominated instrument, like Eurobonds, because investors are conscious of the fact that it's very likely the Nigerian currency will continue to come under pressure. And the event that local currency continues to come under pressure and gives way for foreign currencies like US dollars, how do you insure yourself against such devaluation or depreciation of the currency? So it's going, though we've seen some moderation in those Eurobond instruments, like some we're seeing yield below 10% in those Eurobond instruments. But investors are actually preferring that to investing in treasury bills that will give you 3% in a year. And like I said, you are completely excluded from even investing in normal instruments.
Hello YouTubers, welcome to Moneyline with Nancy TV YouTube channel. This is where we provide you with instructive business directions, processes, and guidance to help you assess the right resources to fund your businesses to withstand every form of internal and external shock. You will find here awesome informative videos on business, entrepreneurship, and lifestyle just to help you make informed business and financial decisions. Punch the subscribe button and let us drive you through the world of business. Please follow all our social media platforms on Facebook, on Twitter, on Instagram, on LinkedIn, and follow us for latest updates on our website. Okay, can you explain what that OMO is? Open market operation for my viewers, please. You are not just speaking to me, Mr. Chukwu.
Okay, OMO is open market operation, like you defined. It's an instrument that is a treasury bills or debt instrument issued by the central bank, and it is used to manage the level of liquidity in the economy. It has the same risk profile as treasury bills, in the sense that it is backed by the central bank, by the federal government statement of good faith that it will pay as at when due. And it comes in with maturities that you could call, you have maturities not more than 364 days, but most of those instruments come in maturities of less than 364 days. It's basically currently only invested in by banks and foreign portfolio investors.
Not for retail investors, so that they don't start thinking that we're talking of a certain detergent or a certain washing liquid. I needed to put
like elephant. You know, there's one called elephant, and you have one elephant.
No, we shouldn't do advert for those guys, you know.
So they are no longer in the market. I'm not sure they're still in the market.
Anyway, that's not for me to say right now. Let's come back to this issue of the MPR, or the parameters kept unchanged. MPR left at 12.5%. The last reduction was done in May. Did we really see any significant change from the May meeting till now? And the adjustment for banks, because we also saw that from that May meeting, we saw even savings rate in banks reducing. I think savings rate is about between 1 and 3% right now. Any significant change from the reduction of MPR from May till now?
No, there was none. And why did I say there was none? Other than, like you said, we've seen further decline in interest rates and deposit rates. The basic thing that happened at the time when that decision was taken by the central bank was at the peak of the lockdown. The decision was taken in May, and the economy was still locked down in May. So it did not reflect in terms of economic activities. The primary objective of the central bank was to drive down interest rates so that banks will expand their lending to private sector, and private sector could grow at lower cost and therefore be encouraged or motivated to go into productive activities. But the reality is that at the period when the economy was locked down, virtually nobody was willing to go and borrow. And even if you had to borrow, there was no economic activity to which you could have deployed the funds from the banks. And the banks on their own would also be very adverse to lending at the period when the economy was shut down. So we couldn't have seen the impact, which is also one of the reasons why the central bank governor said that we need to allow time for the effect of the decisions they were taking in May to be taken into the economy. You know, there's always lag effect, and this lag effect is worsened the fact that the economy was shut down when the decision was taken. So I don't think we've seen any material uptick in terms of credit expansion to the private sector, commercial credits. What we rather saw was the banks had to drive down their deposit rate, and it was very simple. We've seen consistent decline in yield on treasury bills. So when the banks are taking deposit from customers and they are not creating loans, so they can't lend out the money, and the only option they have is to either put this money in Omo or put this money in treasury bills. Remember, about 22.5% of whatever they generate from as deposit from the public will go into the central bank for as cash reserve. So what is left is what they have to invest, and the return on those investments has consistently come down from the high of 18.7%, 18.9% 2-3 years ago, when Omo was trading at that, Treasury was trading about above 18%, to just barely 3%. So the banks had to try to struggle to maintain a positive net interest margin which will mean that the rate at which they are taking deposits will be lower than the rate at which they are investing, the return they are getting from those investments. And if the returns keep going down, the banks had no choice than to further adjust or review their deposit rates. So that's what we saw in the past couple of weeks.
If we take a look at the liquidity ratio also left at 30%, perhaps that would also make the banks, because the problem of holding CRR, like you said earlier, 27.5%, let me explain to our viewers. If a bank has like 100 naira, for example, that means 27 naira 50 kobo will be with the CBN, isn't it? That's for the CRR, 27.5%. So how do you see this, especially from the liquidity ratio side, constraining bank access to cash and also affecting banks' ability to extend credit?
Okay, the greatest constraint the banks actually have is the cash reserve ratio. When you take out the cash reserve ratio, the banks are left with just 72.5% to lend. And of that 72.5%, they need to maintain a liquidity ratio of 30%. But remember, part of the liquid assets qualify as investment instruments. Investment in treasury bills, investment with other banks, investment in normal instruments, investment in short-term maturing bonds will all qualify as liquid assets. But the greatest limitation the banks have is the cash reserve ratio, which earn virtually nothing. But in addition to doing the cash reserve ratio, the central bank has also come up with an unconventional tool to take out, to debit banks that are bidding heavily in the retail Dutch auction market with additional cash reserve ratio. And remember also the central bank had also imposed penalties on banks that did not meet the loan-to-deposit ratio by withdrawing whatever is the shortfall. So these are additional unconventional cash reserve that the banks has compelled the central bank has compelled the banks to submit to. So in effect, when you take out these two minimum reserve that the banks have to keep with the central bank and keep as liquidity to ensure that they meet the obligation as they fall due, then the banks are left with less than, actually effectively less than 65%, which is the minimum loan-to-deposit ratio they're supposed to keep. And the banks have to struggle to keep that and still maintain their liquidity. But as it stands today, the bank's problem is not necessarily liquidity. The liquidity ratio has remained strong, although the central bank governor said we've seen some little moderation in the liquidity ratio. The greatest challenge the banks have is the fact that they cannot assess their cash reserve ratio, and those cash reserve ratio are not earning them income. So what if you take, for instance, if you take 100 million naira from customer and you have to put 27.5% of it in the central bank, you are left with 72.5% to deal with, but you have to pay interest on the entire 100 million. So, and you can possibly earn income on the 72.5%. You must price the deposit at a rate that the income you're in on the 72.5% is enough to pay that deposit 100% and still give you some margin.
Okay, I hope my team will still coming up with a clip from some of the questions that the CBN governor answered yesterday, so that we can take that for the purpose of those that did not see it yesterday. But let's still stick with this, because NPLs, though at the last MPC, the May MPC, the governor of the central bank also mentioned that we're seeing a decrease, that's in NPLs right now, I think from about 9%, I think it was at about 15% at the time, then it dropped
from 11%
down to about 9%, and it's still dropping. How should banks marry increasing or an increased NPLs and also ensuring capital adequacy ratio, CAR, not car, not the motor we drive, CAR, capital adequacy ratio? How should they navigate both?
Of course, you know that an increase in non-performing loan will weaken the bank capital adequacy ratio. So the key thing is that for you to have a strong capital adequacy ratio, that is, you have enough capital to cover the risk you are carrying. That quality of risk must be high. And once you see a deterioration in your quality of your risk assets, it will have a direct impact because you have to make provisions for them. at the minimum, you might have made provisions, and if the loan becomes bad, you have to write them off. So for the banks, the priority is to maintain quality risk assets. The central bank has actually weighed in to help the banks, to relieve them of the burden of the current economic crisis. When the central bank directed the banks to grant some level of forbearance to loan to weak credit customers, or some level of accommodation to weak credit customers, what the central bank has effectively done is to hope that those customers will have their businesses rebound when the economy recovers, so that ultimately the loans will be lost. Because like the central bank answered in one of the questions, that I can't remember, you were the one that asked that question yesterday. If the central bank did not come up with that directive for the banks to grant from forbearance to credit customers, that would have today, those bad credit would have crystallized. And if they crystallize, you'll be forced to write off those loans. And that will directly impact on the capital adequacy of the banks. But by granting them extension of the loans, rolling over the loans, granting moratorium on interest payment, and making those loans to remain performing, what the central bank has encouraged banks to do is to defer the possibility or the time the loan will go bad. And that deferral could work positively for the economy. If the economy rebounds and those businesses resume economic activities and begin to generate cash flow so that they will be able to meet their obligations to the banks. Remember that the past 3 months we have seen very low economic activities. So irrespective of how strong the customer is, unless you have a large pool of liquidity, many customers would have defaulted in paying their loans because they were not engaged in economic activities. I'll give you a classical example. Look at the hospital industry. The hotels were shut down. The airlines were shut down. The transport vehicle transporters were not operating. Assuming the vehicle transporter had borrowed from a bank and needed to service that loan on a monthly basis, if in 3 months he had not paid interest or principal repayment, that loan becomes substandard. You are supposed to make a provision on that loan. So if you take that provision, you begin to put that loan on the watch list, and you are no longer recognizing income on that loan. So that default will crystallize. But by granting them this forbearance, what you have done is that they resume business activities and begin to generate capital. They'll be in a position to meet their obligations. So clearly, the key thing for the banks is to work with their customers to ensure that the loans do not go bad. Because if the loans go bad, it will have a direct impact on their capital adequacy.
Let's talk about inflation that seems to be, on the run. And it seems that the CBN, it's not much of a priority right now to tame inflation. Because if you take a look at it, this monetary authority is doing quite a lot to help Nigeria stir the waters, the stormy waters, especially worsened by this pandemic. Interest rates, 12.5%, definitely benchmark interest rate, but inflation is at 12.56%. The MPC communique, which I have here, they did also mention we have supply chain challenges, rising import costs. We also saw falling purchasing managers index, that's the PMI, to about 41%, that's 41.1% in June. How concerned are you about inflation rates and your prediction, even as we move towards at the end of the year? Also vis-a-vis the consumption expenditure pattern of Nigerians?
Okay, Nancy, for me, inflation, the uptick in inflation is not of much concern to me. Not that it's not of any concern, but not of much concern to me. And I've always said this, that in managing an economy, you have to define what should be of priority to you. Today, I don't think the priority of any economic manager would be to keep inflation lead on inflation rates, or to sacrifice economic recovery to manage inflation. The truth is that you really cannot manage both, given our level of economic development at the same time. Something has to give in. And as it stands today, I think the government, the Monetary Policy Committee, has prioritized economic recovery at the expense of managing inflation.
Mr.
We can
Chukwu,
deal with inflation.
Mr. Chukwu, just hold on there. Won't it erode the value of the Naira? Because if you take a look at, you analyzed earlier on, we talked about the savings rate in the banks between 2 to 3% right now. If you take a look at inflation rate, 12.56%. So if we do a simple arithmetic, if a savings rate is 2 or 3%. So you're having a band of about 9 to 10.56% thereabout. What it means is that you may just be getting half of your money in the next few years or so, in the next few months. So isn't that a concern? Are you going for chasing economic recovery and not taming inflation? Like someone told me on the show years ago, said, Nancy, let's leave inflation, let it be like 70%, and let's just go for economic recovery.
Okay. Back what I was saying, like I said, it was not of much concern to me. And for me, in my scale of concerns, the of greater concern is the level of economic recovery. Nancy, you were dealing with the 23% unemployment rate. Today, if we come up with a figure, we may be talking about 50% unemployment rate. You are dealing with a near collapse economic activities. You are dealing with situation where several households cannot fend for themselves. They can't put food on the table. For me, the rate of inflation cannot be a priority above these key developmental challenges. Priority should be, let's inject liquidity into the economy. Of course, the cost of that injection of liquidity from ways and means disbursement from deficit budgeting will be an uptick in inflation. But if economic activities pick up and productive activities begin to improve, the improvement in productivity will lead to an moderation in inflation. Remember, what is driving inflation rate is not just money supply. You also have to deal with the fact that like the central government, we see supply chain disruptions. The greatest pressure on inflation is coming from food inflation, which came at a rate about 15.08% in June. And food inflation is driven partly by the disruptions we are having in the Northeast, North Central, and now we have Northwest, where most of the food is produced. And then the challenges or the bottlenecks that we encountered at the point when we locked down the economy, and it was very expensive for people to move goods from those local where they are produced, where they are largely consumed. But in addition to that, another major inflationary pressure is coming from the foreign exchange rates. We've seen a depreciation of the local currency. And as long as you have to reasonably import a reasonable quantity of what is consumed here or what is used here, you're going to have part of your inflationary pressure coming from import, your exchange rates. So, and that you cannot control until we further diversify the economy, or if we are lucky, we see a further increase in the price of crude oil, and then the global demand for crude suddenly picks up, that the OPEC will not allow us to start producing 2 million barrels a day. Currently, we're only producing about 1.4 million barrels a day, which even if you add the condensate about 300,000 barrels a day, we just have a production of about 1.7 million barrels a day. Recall that last year we were producing 2 million barrels a day, and crude price was about $64 per barrel. Now it's just about $43 per barrel. So it has a direct impact on our foreign exchange earnings, which also have an effect on the exchange rate, and that effect on the exchange rate has impact on inflation rates. So these factors are not something we can wish away. So given the situation we found ourselves, I don't think anybody who is focused on managing the economy should have as of paramount importance to him managing inflation. It should be, how do we stimulate economic activity? How do we get people back to work so that they earn some income, even though the value of the income they will earn will be partly eroded by the depreciation of the currency or the change in consumer price index. But let them start earning income. And then, as the level of productivity keeps improving, inflation rate moderate. We've seen countries that have gone through very high hyperinflation, and now gradually they see low single-digit inflation rates.
Yeah, but Zimbabwe is not part of that country, or Venezuela. Those two countries should not be in the it should not be in the list, or shouldn't be in the equation. Even striking doctors in Zimbabwe right now want to be paid in US dollar. Is that bad? But that's a topic for another day. Let's talk about the Nigeria Infraco PLC, which the CBN governor did say yesterday that the federal government has approved. The Infraco PLC will be a company that would address critical infrastructure challenges which have, faced us for quite a while. What are your views about it?
I can tell you, Nancy, that it's a good development because I have actually seen a similar development in India. One of the things India did was to set up a company similar to the Infraco that could co-invest with other funders in some critical infrastructure sectors of the Indian economy. And I think that's what the federal government wants to replicate, where Infraco will invest in some of the critical infrastructure. And remember that Infraco is being funded by a number of the federal government, a number of multilateral funding partners. So ultimately, they will be able to invest in some commercial infrastructure with some foreign investors, and that will help us moderate or to some extent the level of infrastructure deficit we have in the country. If you just cast your mind back to when the Nigerian Sovereign Investment Authority was established, among the three funds that the Nigerian Investment Authority was required to set up was an infrastructure fund. And that infrastructure fund was supposed to co-invest with other funders in critical infrastructure. The first project they would have successfully executed would have been the second Niger Bridge, but unfortunately it was reversed into the budget. And because of that, we are seeing delays in the implementation of that infrastructure. But now I believe that it would have been concluded. So I think the government is beginning to think, we're beginning to be nudged into thinking the right way to bring in private sector to support some of the infrastructure development in the country. The reality is that, and I've emphasized this time and time again, that the government does not have the revenue profile that it can build the required infrastructure from budgetary allocation. So I was quite excited that we are taking the right course of action. Just a few weeks ago, the Minister of Works said they are going to concession some of the highways to private sector investors who can now manage them. And I did mention that we should go beyond that. We should actually concession for them to build, operate, and transfer, or build, operate for some time under some public-private partnership arrangements. We really look at how many years it's taken us to build the Lagos-Ibadan Express Road. Assuming we are giving that to a private sector company, concessionaire, by now we would have been driving on very good road. And then maybe the investor would have recovered his money over that 18 years it's taken us to build that highway.
Okay, let's talk about the MTTF and fiscal strategy paper a bit. The MTTF has been approved by the Federal Executive Council. Quite interesting numbers for me that when I was taking a look at that. All price benchmark, of course, the MTTF for 3 years from 2020, okay, let me just break it down. The budget for next year at about 12 trillion naira. What do you really think when you actually saw those numbers? Nigeria's current crude production is at 1.4 million barrels per day because of the OPEC plus quota. The meeting that was done, I think, about 2 months ago, our production level is about 1.4 million barrels per day right now, and an additional 300,000 barrels per day of condensates, totaling about 1.7 million barrels per day. Mr. Chukwu, give me your own analysis of this. Is this something that we can meet 12 trillion naira next year? So it will be in the bands of that from 2021 to 2023, assuming all things are equal, isn't it?
Yes, Nancy, what I would say is that these projections are overly optimistic. To be projecting a revenue of about 7.2 trillion naira next year, based on a projection of about 5.6, 5.8 trillion this year, looks too optimistic. Even the current projection for this year, it will be a tall order for us to achieve it. Granted that the government actually adjusted the exchange rate. So when you convert the foreign exchange earnings from crude oil sales at a higher exchange rate, you see a larger naira receipt. But even at that, you need to begin to imagine that you convert at something like 700 naira or 1,000 naira to $1 of the crude oil proceeds for you to achieve a revenue projection of about 7 trillion naira next year. Last year, total revenue of the federal government was about 4.6 trillion naira. In 2019. Last year, crude price was $64 per barrel. Last year, average crude production was 2 million barrels a day. So this year, we are dealing with a crude production of just about, you mentioned 1.4 plus 300, about 1.7. And then we are projected to earn more than 5.6, 5.8 trillion naira this year, and we want to increase that to 7.2 trillion naira next year. I think those
Mr. Chukwu,
projections are too optimistic.
aren't you encouraged that the Minister of States, that's the Minister for Budget and National Planning, did also mention that they will get about, I think, 60 or 63 government-owned enterprises to contribute to the revenue for us to get a target of 7.5 trillion naira.
Okay, Nancy, the key thing about it is that if you look at those agencies that will contribute, they are already contributing. If you look at the breakdown of government revenue, you have independent sources. Those independent sources are revenues from the likes of NEMASA, the Nigerian Ports Authority. Now that JAMB is contributing positively, the likes of JAMB and what have you. I do not see the level of increase in economic activities that could lead to such an increase in the revenues of these independent sources. That for me is, and let me tell you where the challenge comes from. If you look at our budget in the past 3 years, you will realize that we've been borrowing. The budget deficit, actual budget deficit, I mean, the neighborhood of average of about 3.5, 3.6 trillion naira year in year for the past 3, 4, 5 years. Okay, so in effect, this year we are budgeting that the deficit will be more than about 5.3 trillion naira effective deficit, because we have, if you take out we are budgeting 10.8 trillion naira. And the revenue is going to be about 5.5 trillion naira. So you're talking about 5.3 trillion naira deficit. When you add up these things, we're creating a hole that will be difficult to fill. And we remember we're borrowing. So your borrowing capacity will continue to diminish as long as your loan stock keep increasing. Because your capacity to service those loans will weaken if the volume of loans you have outstanding keep increasing. So next year, we may not have the same capacity to borrow as much as we are going to borrow this year.
Okay. Okay, Mr. Chukwu, in just 10 seconds, I want you to answer this question for me. Who do you think has the toughest job right now in the country? Who do you think has the toughest job? Is still sitting on a keg of gunpowder?
I think it's Mr. Godwin Emefiele.
Wow. Okay.
Without thinking twice. Okay. He's now responsible for all aspects of the economy. He's the goalkeeper, he's the attacker, he's a midfielder. It's managing monetary policies and also following into fiscal and fiscal policies.
Okay, I think I'll interrogate that further. Let's see, Of course, that's what I do every day here. But many thanks for joining us on today's edition of the program. Thank you very much and have a great day.
Thank you for having me.
Thank you for watching our video. Please hit the subscribe button below, turn on post notification to follow all our updates.